Joining us is Michael Vogelzang. He's Chief Investment Officer of Boston Advisors, which manages $1.8 billion worth of assets. So, Michael, not out of the woods yet. How come? Maybe that housing data kind of reminds us that housing's still a problem?
Yeah, boy, we just look at the world not quite seemingly as shiny and bright as everyone else is seeming to do today. You know, we're actually very positive on the long-term outlook for the capitalist global system, and you know, things are a lot stronger than they were a year ago. You know, we avoided the financial meltdown and sort of the Great Depression. Having said that, stock prices are, as you said, you know, 60–70% higher from the lows. Corporate profits still haven't really turned the corner. We haven't seen revenue growth. We have unemployment very high. We think housing is going to roll over a little bit. So all of those things don't feel to us like they're priced into the equity markets for sure.
Do you feel like that?
So we're just a little bit worried.
Right. And then having said that, though, if you look at the valuation on the S&P, I mean, certainly above its 5-year average, does it feel like the S&P a little bit pricey here?
Yeah, it's certainly pricey. You know, you know, look, anybody can argue any valuation you want. It just depends on what number you use. The real issue, I think, by almost anyone's estimation, is that the S&P is priced for very, very good earnings estimate and earnings performance next year. We just don't think that's particularly in the bag. You know, the market's risen 60% straight from the bottom. We expect there to be a break. Just simply psychologically, we need to have a pullback. We're chasing. A lot of people are getting pulled in. We'd expect to see a market break and a market pullback here this spring. You know, we don't know exactly what size. It wouldn't surprise us if it's 10 or 15% back down to 900 or so. But at the end of the day, we like the long-term prospects of the market. We're just a little bit worried about the direction going forward.
Do you find it unusual, Michael? Because I was checking out, you know, obviously the trade today. You got the S&P at a new 52-week high. You also have the Russell Index at a new 52-week high. So both small and large caps making new highs here.
Right. The other thing that's making a new high is the utility industry, the utility sector, which is very surprising. Typically a very defensive industry. Now there's some industry-specific things going on with cap and trade and so forth. But yeah, there's some very interesting signs. We're still worried about mutual fund flows. Mutual fund flows have not improved. They certainly haven't improved according to or as well as the markets behaved.
Right. So much money going into bond funds at this point, correct?
A lot of people are going to bond funds, and you know, we're gonna see interest rates rise as well. We just think, again, you know, looking at the economy, we think there's some risk areas. The first is, how's the Fed going to pull away the punch bowl? We're in the holiday season, but they're going to have to start pulling it back sometime this year. And you know, at the end of the day, they've never done it this way. We've never been through this cycle before. We've never seen this kind of stimulus. We've never seen the kind of governmental programs we've had. And how are they going to get that stimulus away from the market in a gradual way? We think when they do, and we hope they do it well, we think when we do, there's room for mistake, and there's potential risk to capital markets. And we're not talking about cataclysm. We're talking about a reasonable pullback when people get a little unnerved, when they start to see short-term rates rise. We start to see long-term rates rise, as we're seeing. We're worried about the dollar. You know, the dollar's been in a free fall effectively for the whole year, while everyone's been running this carry trade for effectively positive carry and investing it in risky assets going up. We just think that that now that the dollar's starting to unwind, some of those risky assets are going to lose a little bit of the helium. So we're not negative. We're not terribly worried about long-term things. We just think that a lot of this stuff has been overdone. Right. A lot of the correlations have been very positive. Right. We've seen gold and stocks and commodities and energy and everything going up together this year. Okay. And that's worrisome. So anyway, it's basically our view. We're just a bit worried for the first quarter. That's all. All right.